Hello and welcome to Trading with Technical Indicators. My name is James Boyd. Today's date, August 31st, the last trading day of the month. Tomorrow, September 1st. Got some things moving around here today. We'll talk about that in just a moment. Now, just real quick, we'd like to welcome all of you here today. We got with us Grace. Hello, Grace, back to you. Josh Pink with us. We got Will with us. Hello, Will. Jeff, Sam, JD, David, Ted, and many others. We also have Mrs. Canada with us here today, and you know her, Barbara Armstrong. We welcome her. And last time Barbara came over and planted all those flags on my house, I'm going to have my guard dog Jax be watching the door. And if Barb comes over one more time, this 9-pound Rottweiler, I mean Yorkie, is going to be right there for her. Barb better be fast this next time. Some of you saw those flags from about a year ago, so a little fun there. It's always great to have Barb with us, and also razz her as well, as she does to me as well. Anyway, a little fun. Now, just real quick as we get started, so this class we're going to be talking about trading with technical indicators, and when we talk about this, want to kind of give us a reminder that you could also follow Barb and all of us instructors on X. There's my handle. Barbara can actually post her handle there in the chat that we can click on it and follow her as well. We do post educational content and examples. Our examples will be stocks, options, futures, all of the above. So make sure you take a look at that. Now, just real quick, coming up, if you went to schwab.com/events, okay, just go to that, bookmark that. You can see in-person events that we actually have all the way into end of March next year. Now, we just this last weekend did the New York Advanced Option Workshop, and that was this last weekend on Friday and Saturday. Upcoming September 19th, we have what's called a one-day event. It's the Market Drive, and it's going to be at the Scottsdale at the Phoenician. Okay, so you can go to schwab.com/events and register for that. You might live in that area, be traveling to that area. That's a one-day event on September 19th. Join us. Also, back on the East Coast, Washington, D.C., that's Technical Analysis Day 1 and Option Strategies Day 2 at the Ritz-Carlton in Washington, D.C. So we all learn in different ways. Some of us learn from an online course. Some of us learn from maybe an online class like this. Some actually learn better in an in-person event. We want to make sure we provide really the venues or mediums, if you will, how you could actually learn best and absorb the information. So go to schwab.com/events, check out some of their upcoming events in your area. Now, also remember that with what we discuss here today, the information is provided for general informational purposes only. Options carry a high level risk, not suitable for all investors. When we talk about examples, we will do those on the Paper Money software application. As we go over those examples, you might have some questions. Love to answer those. Barb's in the chat full time looking at those questions. I'll also be looking at those as well. And also understand when we talk about investing involves risk, including loss of principal. Now, today I really want to kind of focus on some of the price action that we're seeing. I want to focus on price action and the MACD, whether we talk about some divergences or the MACD actually holding up stronger and staying above the zero line. We got some examples that we can look at here today. So that's going to be the focal point. Now, this morning when we actually woke up, I don't know. I woke up at 3 a.m. Okay, just thought it was a good time to wake up. Okay, so I've kind of been seeing this action for hours. But if we look at, let's say, the crude oil, I mean, this is the tail of the tape so far. Now, this diagonal line that we've been talking about or had for 2 weeks now, maybe 3. That diagonal line, we're taking another run at this diagonal line. Now, some of us, we've kind of been talking about, wonder if that stuff overseas continues to happen. And here's the deal. We've been in this for weeks, months, etc. You know, they're ahead of us time-wise. We kind of had some more disruption overnight, and you saw crude oil bump up a little bit. Now, can we say it like went up $5, $7, $10? No. But we did actually see the price get above the diagonal line again. I haven't adjusted the diagonal line. That was the old diagonal line, and now we just took another run at it. We actually didn't really fall down, okay, to fresh new lows. We maybe went to $80. That's it. Not much of a drop on the MACD at all. Of course, when we talk about the crude oil, we're talking about the IXE, the energy, okay? Now, there's a couple stocks that we actually have in the paper money account. We'll circle back on those. Are there any stocks in that area that you're looking at, that you're willing to share? Speak now, forever hold your peace. Now, when we also talk about the volatility, okay, did volatility really spike to the upside? No, 15-ish. My gosh, I mean, we actually hit a brand new low at 14. Hello. On now, by the way, what does that tell us? Okay, remember, if you have a VIX level of 16, the S&P fluctuation from low to high, or the range, is only about 1%. Okay, so if we didn't even look at the market and we said VIX is at 15, I'm thinking the market is not very volatile right now. When I say the market, I'm talking about the S&P 500. Okay. Now, some people don't like that, but that's why there's different strategies in different market environments. Now, where we did see some some difference from last week to this week was really in the interest rates. The Treasury last week tried to kind of come in, kind of get the rates to come down. Didn't really work out very well. 4.75 on the 10-year. Ooh, okay. Now, again, what does this tell us? Number one, inflation has stayed actually pretty high. We've also seen, for example, that risk, okay, might be becoming higher in terms of owning U.S. debt. You got to also remember something is also investors are saying, look, we're not going to loan you that money for as cheap as you want it, okay? And this is where it's kind of interesting is you could actually say that maybe the Fed, the Treasury, whatever you want to call it, or the combination, kind of losing the control of that interest rate. For a long time, they artificially pushed it down. Okay, we'll use the word artificial. QE, you guys remember that? And so the biggest actually thing is kind of losing this fight on those rates. Now remember, that affects borrowing costs, car loans, student loans, home loans, you name it. Okay, corporations borrow with this kind of as a basis. So seeing that actually go up, it could affect some companies' profitability. Now, not everything. Okay. Some might benefit from that, and we'll talk about that in just a moment. But that's a difference, and that's not just like, oh, it's up for the day. It's up to a brand new high. Now, if you have cash, now let's think about something. Okay, there's a lot of money out there, a lot of money. You got to remember, if someone goes out and says, "Look, I'm going to go put my money in, let's say, a product that's trying to make money from time," rates up, prices where the price is down. Okay. So the biggest actually thing we got to remember is someone's not necessarily trading maybe the move in the rate per se. They're trading the price. They'd be short that product, thinking that the rate is going to go up and the price falling down. Okay. Now that brings us to the point, which is how is those rates actually affecting the S&P 500? Now remember, if someone is trading the market, they're trying to trade the short-term price movement. Let's just say they're trying to do it bullish. For most people, it's probably bullish, okay? The S&P, as the rate went up, the S&P dropped. Did it break support? No. Did it go down? Yes, it did. But obviously that 7,600 is the marker that we're really watching, okay? The higher and the faster the rates go to the upside, the greater the chance the S&P 500 probably does not hold that 7,600. Be watching those rates. Do not be foolish and think, oh, the rates have nothing to do with it. Yeah, they do. Okay. And so the S&P did not break, but it went down to the moving average, the 20-period moving average. The NASDAQ, did it break? No. Matter of fact, we'd actually have to say the NASDAQ was the strongest of the indexes. The third one, we actually saw the Dow Jones sitting itself right on that 530 threshold. And I'm not even going to I'm not even going to show you the Russell 2000 because it's too graphic, lower low. And the mid caps as well, too graphic, okay? Lower low as well. So some investors right now, they're trying to hide in some of these bigger, large cap names. I call them the battleships, if you will. Big balance sheets, big income statements, can weather different types of maybe domestic, international news, data, etc. People are hiding out right now, it looks like, in some of these bigger names. Now, when we talk about, let's say, even the movement we saw just real quick in the US dollar, based upon some of the comments from the Fed last week, the dollar went up a little bit. We know where this goes, okay? US dollar actually up. Some of the investors sold their gold pushing down last week. Now, could those investors be coming back? Is that dip in the price? Would you really want the US dollar long term? If you're going to 40 trillion, 45 trillion, 50 trillion, 60, do they really want that paper? Maybe not. So these type of drops for some investors, they might say, hey, come on down. That investor might say, I want to try to buy more. Okay. And so the biggest thing is when you look at silver, we would expect silver would be pretty volatile as well in spikes of volatility. We saw that late last week. Silver did go above what, north of 72, down at 67. Remember, silver, this is someone who's trading that price volatility. If you said of the two, the volatility is higher in the silver. Okay. So always remember that. Now, let's kind of talk about some of these stocks. And I want to go to just real quick a stock, and I want to go look at just real quick a banking stock for just a moment. Okay. Now, I'm going to throw out a question. How could someone buy a stock in a market that's just so crazy? All right. Now, I don't feel like that, but let's just say I said that. Okay. Now, this is where, for example, it's not. So A is if you buy a stock, which direction do you think it's going to go? Second is what type of strategy. The strategy, what you pick, what type of strategy you pick, could it actually determine whether you're overall profitable or not. Okay. Now we know if we buy a stock, they don't pay a dividend. We know the break even is what we bought the stock for. But if we do some other strategies, like I'm going to show now, how does someone confidently maybe go out there and invest in the market where the market might be a little bit more indecisive or have some risk? Now, one of the things we talked about last week extensively was, look, if we just come in here and let's say buy shares of stock by itself, right click, buy custom with stop. And I'll go with OCO bracket, okay? Because we will put a target on this. Number one, if we buy those shares of stock, let's say we buy 100 shares, okay? And I'm going to talk about the technicals in just a second. Just want to hit strategy because this is a part of it, okay? Let's not kid ourselves. If we buy 100 shares of stock, that's the break even if we don't include the commission. Second, that's the target. We'll come to that in just a sec. Tell me where you think that target is. And the risk of this position is really, if we set the stop at $84, hypothetically, just as an example, well, if we go down to $84, it triggers the stock to be sold at $84, could be sold at a lower price. That's the bad part, right? Sometimes you go down to 84, maybe it fills, and then the stock bounces right back to the upside. So let's say I said, hey, look, I think the market could be a little bit more volatile. And I don't want to get stopped out, only see that stock maybe go right back to the upside, maybe some of them. Well, let's kind of do something a little different here. So first off, I'm going to come in here and buy those shares of stock. Now, we do not need to buy 100 shares of stock. What I'm going to do is I'm going to come in here, example given, I'm going to buy about 75 shares of stock. Oh, for crying out loud. If we bought 75 shares of stock, that was a share price of $86.57, that would really be about $6,400. We're not talking about life shattering here, okay? But let's say we just said, hey, 75 shares. Now, second is, if I did this, if I came in and said, look, what I want to do is I want to go single order, first trigger is SEQ, first trigger is sequential, meaning do these orders in a sequence. The sequence is buy the shares first, number one. Number two, buy the put. Now remember, if we buy that put, what does that give us the right to do? It gives us the right to sell the shares at the strike price from now until expiration. Okay? Who controls that right? The buyer does. So remember, if we actually do this trade, I'm going to put this on the analyze page and just put it on there. If I click on this, go single order, first trigger is SEQ, we need to do that. And I come in here and say, look, I want to buy the put. Well, what does this do on the diagram? Okay, we know that diagram is going to show a diagonal line. The diagonal line is your profit loss. The stock goes up to the right, down to the left. Okay, you're just plotting it. Now, what happens if we add that put piece to it? Well, if I add this to it, analyze that trade, you're now going to see that it actually flatlines that mark. That's the lowest point. Okay. And what that's actually saying is, hey, we have a right to sell those shares at 82.5, the strike. And if the stock goes lower and lower and lower than that, that line bends to the upside. This is double jeopardy. Does anybody know why that line bends to the upside? Why is it not flat? And by the way, if you get this right, you're ahead. Okay. Now I'll tell you what this is normally going to look like. Okay, 100 shares of stock. Okay, 100 shares of stock. That's what it normally looks like. 100 shares of stock, flat line, because the one contract represents that you could sell 100 shares. Okay, but wonder if we actually say, look, I'm just going to buy 75 shares. Well, what's going to happen is as the stock goes lower and lower and lower, if it does, the delta of the put gets bigger and bigger and starts to offset more the 75 shares or 75 delta. Okay. And so that's what it's saying is if we get the direction wrong and if that stock goes further and further and further down, what can happen is we could even maybe make the loss even less bad. Okay. The farther the stock actually goes down. Now, which way do we really want it to go? Of course, we want it to go up, else we wouldn't buy the shares of the stock. Okay. So you're now going to notice that when we actually move this over, we have unlimited upside. So this is a question that people have asked me. I'm answering. We don't have to buy, let's say, 100 shares of stock. The minimum that we would use in an example would be probably like 40 shares, preferably 50. Okay. But I'm going to show some examples of 75. Okay. $6,400 worth of stock. Trade example number one. Wells Fargo, bullish with a target. Now remember, if the stock goes down, I don't have to freak out because for the next, let's say, a couple days to August 16th, we have a right to sell the shares at 82.50. A long put is not a stop. Long put is a right to sell the shares from now to expiration. Who controls the right? We do. A stop is a trigger to sell. Okay? So that stop could be triggered even though I'm not around. From now to expiration, we control the right to exercise. And that word control is really important. Okay? Now, let's actually do this. I'm going to go back, bring this up in the paper money account. Okay? By the way, is there any target that you would consider on WFC? And so, wonder if the stock went up. Wonder if it did. Okay? Now, I'm going to do the exact same trade. I'm just putting in the paper money account so we talk through it. Single order, first triggers SDQ, and I chose the 82.5. Now, by the way, you can look and see what those numbers would be for max loss, etc. There it is. That's the trade. Now, remember on this, if we got a 155 bid, 160 ask, you're going to see that I'm going to push that down. Maybe like in the middle, probably 158. It's nickel wide already. Okay. Now, here's the deal. Naresh says some very good comment, which is, but exercising would mean selling 100 shares. Yeah, that's true. So if that stock actually does go down, okay, and so the major point is, do we want to exercise the shares? The put. Do we want to exercise the put? No. If that stock went down to, let's say, 80, 77, 75, 70, we're not going to exercise the put. We're going to sell the put and try to use that put to counterbalance the loss on the shares. Okay? All right. Now, what I'm now going to do is confirm send. There it is. Now, what is this called? What's the strategy called? Now, if we looked at this and said, well, what's the break even? Well, if we buy the shares at 86.55 and we buy that put for $1.55, $1.58, just add the two together. Okay, 86.55 plus $1.58, it's going to be 88.13. So I need really $1.58 of upward price movement from the third Friday in October to be at break even. So this now the con of this trade, two major parts, which is number one is time decay. I don't want this stock to just go sideways forever, right? And the other part is if you buy an option, we need some volatility. The volatility drops, it decreases the option value. Those are two main headwinds: time decay and volatility. Okay, now here's the deal. Now notice is if the market becomes more volatile, I'm going to be buying more puts, okay, especially on stocks that have lower implied volatility. When I say lower implied volatility, maybe let's say stocks have an implied volatility of, let's say, 25 or less, okay? Now what I'm going to do is send that order. There it is. Now I also want to go back to just real quick. So first off, any other questions? Now, Lauren says, if you get exercise. Well, here's the deal. If we're going to be in a situation by the October expiration, so the overarching is how do you manage the position? We're not going to hold that position all the way to expiration. Because if we hold that position all the way to expiration and the stock is below that strike price, that could be exercised, 100 shares sold, you got 75, you're actually net short 25. Okay? So the thing is, we're not going to let it go all the way to expiration. We're going to look to get out 4 to 10 days expiration, but in the meantime, we're looking for the price to move to the upside. Wait, is this a bullish trade or a bearish trade? Type it in the chat. Is it a bullish trade or bearish trade? Well, based on the diagram, James, that line went woo to the upside. It's a bullish trade. Okay? Now, so on this example, what I'm going to do is I'm going to go in here on that trade tab. I'm going to right click on that 75 shares. And when we talk about managing the trade, what do we want to do? I'm going to put a target on it right at the ballpark level. Let's put it on together. And I'm going to say right at about 70, about maybe 94 and 3/4. 94 and 3/4 really represents the upper part of the channel. All right, right there. Now wait. If we have 75 shares of stock and we sell 75 shares of stock, what is left on the trade? What's left? It's a long put. And if the stock goes to the upside, right? Stock goes up, the put value should become, fill in the blank, less. And so there might not be anything left to sell. Now, if the stock goes up, should the investor probably be able to be profitable on that? That's the idea. The faster, the better, because less time decay. We talked about the downside. We talked about the sideways movement. We talked about the upside target. And I'm going to put that target right there. Limit, day, no, GTC. Confirm send. Okay? Now, let's go to the second one I want to really bring up. Now, the reason why I brought this up is we were talking about interest rates. And a lot of these banks are sitting on wads of cash. Now, what happens is if they can lock in depositors for 2.5%, but actually the 10-year is actually getting higher and higher and higher, and those depositors are locked in at lower rates, and the banks could keep rolling over that money, the spread between what they're actually paying and what they're getting becomes higher and higher and higher, and you know where this goes. The profitability of some of these banks might be higher. That's the idea. Now, the con about that, rising rates, you might not have as many borrowers. Okay. Now, so that's trade number one, Wells Fargo. Now, second one I'm going to go back to is the big green machine. Don't act like you forgot. Now, we did a trade on this on John Deere, and we were talking about some of the news that had actually come out about the stock, and kind of, you know, they locked their software down where farmers couldn't really identify what was going on with their machines. You had to take the machine in, and as you probably can imagine, it's just hard to kind of roll in their combine, okay, and get something fixed in the next 30 minutes. So, and it becomes a multi-thousands, hundreds of thousands. My family has about 6 John Deere combines in Genoa, Colorado, and it's not like you can just easily drive them down, okay? Kind of a little headache, okay? And we're talking about something where it's, you need them. You don't have that machine. You miss those windows of harvesting. It could be massive, okay? And you also have greater risk, okay, is that your crop's sitting out there underneath the elements. Now, and it might be finished for harvest. Now, if we take a look at this, we came up really close to that target there. Okay. That target is at 661. Now, we almost hit it the other day. And you're going to notice on this order, it's a fractional share. The paper money account doesn't work well if you have fractional shares. We talked about that last week. But I want to talk about a new trade on this. Now, a lot of times, people will tend to probably look maybe a little too much at daily charts. The problem with that is it's not a bad idea to also look at these weekly charts. Now, we said the basis for any trade is the price is above the 10 period moving average. That is so important. Okay. Now, if we looked at this, it'd also be nice that on the weekly chart, there are some tailwinds of the price above its 10-week moving average. So on the longer term chart, tailwind of trend, momentum, above the 10-week moving average. When we look at this price pattern on the chart, it's kind of showing that U or continuation type pattern. Now, if we came back to this, we said, let's go look at the daily chart for just a moment, that one year daily chart. You're going to see on the price graph. Now, can anyone help me? If anyone feels like they're pretty good with candlestick analyses, can anyone tell me what type of candle that is? What is that? Is that a spinning top, a harami that I'm pointing to? Is that an inverted hammer, a hanging man? What do we got here? Now, whenever we see those lower shadows or the tails, okay, where it goes so far down and then it whoop, closes up near the high, and that closing up near the high is really above the previous day's high. Ding, 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 ding. You thought this was going to be boring. Shame on you. Now, the biggest actually thing is when you see this, this is where the sellers sold it down and tried to stuff that price down. They couldn't hold it down. And then all of a sudden, they rammed it right back up and closed it up near the high. Bulls won. No, we're not talking about the Chicago Bulls. Okay, that'd be a little much. But the biggest actually thing, the Bulls, the buyers won. Okay, now what you see today is the price gaps to the upside. I always love when those Illinois people really get feisty. I always love that. Now, here it is. So now we could say, oh, we missed it. We missed it. Okay. Now here it goes. We're up near the prior high in one day. Now let's go back to something for just a second. Remember we talked about last week about these highs on the chart, right? Remember we talked about these three different lines, which we can't see? We actually see the orange line is a 10-day high. Blue would be a 20-day high, and that gray is a 55-day high. So whatever, if we said we're a breakout investor, and when we say breakout investor, we're saying, well, what duration of time are you talking about? Is it a duration of time? Is it a horizontal diagonal breakout? All the above. Well, it's not going to matter on this example because we pretty much are almost hitting all three lines at the same time. So the shorter term investor, the intermediate investor, the long-term investor, they all might be trying to dogpile on top and try to ride that trend. Now, they can't see the future, okay? But they're saying, hey, we're seeing a higher low into some areas of resistance. Now, here it is. If I went back on this and said, okay, what's the volume like on the big John Deere machine? Well, the volume on that is 580,000. It's not the biggest. Now, when we see lower volume like that, we're thinking, well, okay, so we got shares already. We see those there. But if I come down to October's, okay, and remember, we're not looking at September's as much. Why? Well, because we always say we're looking for at least 20 days. Why? Well, because we look to exit with 4 to 10 days expiration, meaning that's not going to give us but 8 days to maybe get in and get out. That is quick, okay? Now, some people do that, but in our class examples, we try to ride those 2 to 3 week trends. That's not going to give us enough time. So we're now going to go down to the October, the monthly options. And now when you take a look at this, we're just going to double check is there anything over here that really has a tighter spread? And I'm looking over here at the put side, $1.10. Ooh, drive a truck through it, $1.60, $1.50, $5. Okay. The tightest one that we could really see is probably that one, the 600 or the 590. Now, the wider the spread, the harder to get in and out. Okay. I could come up with an analogy, but you probably guess what I'm thinking about saying. So if you sell something, you try to buy it back, you have to overcome the spread. Okay. And to overcome the spread, you need the price movement or time decay to go by. Now, I don't like that spread, but if we did this, okay, if the investor said, look, I want to sell the one that has the highest open interest that we're showing, it's 590. What is the delta on that? Well, it's 17. Wait, why would you do a lower delta? What's the purpose of doing that lower delta and trading the technicals? And then we're actually talking about the strategy. Well, if we actually pick something that has a lower delta, a lower statistical chance of closing below that strike price, a lower statistical chance of actually touching that strike price. Now, lower chance does not mean no chance. So if we said, hey, we're going to sell the 590, the biggest thing that we're going to have to do is make sure that we get somewhere in the middle here. Now, what does that mean? We might not get as filled as fast if I looked at, let's say, something like NVIDIA. Okay. Now, if I did this 690, I'm going to do this. I'm going to sell the put. What does that mean? It means we're a buyer of the shares at the strike price from now until expiration. We're the seller. And if we sell, we don't control anything. We're the buyer. Someone who bought the put can exercise their right and give the shares to this paper money account from now until expiration. So what we're going to do is, in this case, trade number 2, sell the put, 590. Where's the 590 on the price chart? The 590 is down here. Now, we would never use language like there's no way that it can go down to there. Oh, that's the funniest words ever. So the biggest actually thing is, if there's time, there is a way. Okay. Now, a lot of times when people sell these puts, they're trying to sell it. They're trying to sell them where they think there's a support. With that support, there could be a price pattern and so on. You could say there's a support in the general area. 590 is the strike. And the break even, where is it? It's at level of 583. So 583 is going to be, if I go back to that chart, where's the 583? It's about right there. It is at the lows. So if the investor took ownership of the shares of the stock, it's in the gray box. If they subtracted out the premium, it's right where my pencil is, right near the lows. Now, the con about a lower delta is you don't get as much premium. Okay? Now, so that's trade number 2. Let's send it. And notice that commission there. Now, the other one I want to go back to just real quick is I want to see if there's any questions. Now, the comment was you're tying up a lot of money by selling the put. Well, it depends on which account you did it in. If we did it, let's say, in an IRA, that's a true statement. We did it purposefully in the margin account for that reason. Okay? Now, let's also go back to another one, and I want to take a look at just 2 stocks just really quick, okay? One of them that some investors might be looking at. Now, how many of you like to buy things after a pullback? Is anyone here kind of saying, yeah, James, that's where I like to come in? I like to come in after the pullback and maybe where that stock is maybe trying to reverse. Is anyone in that camp? All right. Now, so when the market is down, it is also interesting to kind of see which stocks might be up. One of the stocks that was actually up in a down market was actually QCOM. Now, what you're now going to notice is, if you take a look at this, QCOM was actually one of those stocks where you saw it was really kind of, if we said, where do we see horizontal resistance? Okay. And by the way, I'm going to put on that MACD where we can see that. And I'm going to, well, actually, go to that other chart. Let's go back to that. There it is. And I'm going to pull up QCOM. Okay. Now let's kind of talk about this. Now, when you actually look at the MACD, the MACD has those three main settings, right? The faster setting, and we're talking about using a 1-year daily chart, would be a 613.9. Faster setting. Okay. Medium setting, 817.9. Slower type of setting, 1226.9. Now, good thing about faster setting is it's faster. The con is you get false signals. There's less time to get more confirmation. Go all the way out to the 1226.9, you feel like you're day late, dollar short, but there's more confirmation. Now, if we went back to this, a lot of things that we're seeing in the marketplace right now are things where the price went up, the MACD actually goes up and it fades, but it doesn't really go into, let's say, that red histogram down there in the panel. Now, what you're going to see on the right, to the right of where I'm pointing, we kind of see where those light green bars are building, which means A, the histogram is above the zero line. 2, the momentum, MACD, is getting more and more and more. Now, you like to see that building up of momentum as the price is going up near resistance. Now, if we take a look at this, if we zoom in on this and said, okay, let's go back to this. If the price was able to break resistance, that path of least resistance, if we did this, might be in the vicinity of, let's say, this level, 179. Broke the next level, and I'm just looking at the next two areas, it'd be 192. Now let's go back to my first initial comment, which is, well, James, this market's crazy. Okay, so here's the thing. You had different seasonality of the markets. Sometimes the market's way volatile. VIX is at 30. Other times the VIX is at 14. It's going to be hard to really, with someone that's done this for long, if you said the market is crazy and the VIX is at 14, things move around, okay? If you told me VIX was at 14, I'd be thinking either have lack of price movement or you have upward trends. Sometime in summer months, you kind of have some price neutrality. The trends are not always up. This is why some investors say, look, I'm going to forecast some direction, but I also want to try to benefit from time decay. Now, I can know all about the strategy. Doesn't mean I do them, okay? Now, let's say the investor said, James, I want to buy some shares of stock, but I want to maybe say, well, wonder if it's not as bullish as I thought, okay? And you want to put a cap on that trade in the short term. Now, what I'm going to do is I'm going to come back into QCOM, and I'm going to come in and say, look, I'm going to right-click, buy custom, okay? And what I'm going to do is, let me go to the trade tab for just a second. Click on the ask price, okay? So I went to the trade tab, clicked on the ask price, and let's say in this example, we said, look, I'm going to buy the shares of the stock, and I'm going to agree to sell those shares at a certain price. Now, look, if we thought this stock was going to go just smashing to the upside, the investor would say, look, forget offsetting something or capping the position. I just want the shares by itself. Understood. But let's say we kind of played into like, look, let's say I think the market might be a little bit more neutral. If it is, we're going to come down to single order. First triggers SEQ. Trade number 3 is we're going to go down and see something down here, the October. We're going to come over here to the right-hand side, and the implied volatility on this stock for this expiration is at 43. Now that 43%, which is annualized, that tells us something about the forecasted price movement, but also something about the premiums. If that implied volatility percentage is higher, the premiums are higher. If the premiums are higher, that means we can make up to the strike price plus a bigger amount, which is the premium. So if we said, look, I'll agree to sell my shares at $180, but if you're going to buy my shares at $180, bring your briefcase because I want from 169.5 all the way to 180, which is 10-ish dollars. And don't forget my $580 on top. Now, do we know the stock's going to go to the upside? Don't know. Now, but why are we doing this trade? Well, on this trade, it's going to really cap us out right around $1,600 for the next 46 days. $1,600 on about a $16,000 investment, that's about 10%. Now, the biggest actually thing is, wonder if this stock just went completely sideways. It was only up 2 pennies, whatever. Well, we get the premium. If it goes down 580, we're covered by the actual, and I'm talking about it goes to expiration. The break even is 580 lower than what we would buy the stock for, assuming we get to keep all the premium. If the stock is anything lower than 580 from where we are now, we're actually losing from now to expiration. Okay? So the biggest actually thing, and I'm really, just to be simplistic, we're saying at expiration of it, we're 580 lower than where we are now, we would be in a losing position, or should be. Now, when we take a look at this, what type of strategy is this? It's a cover call, okay? It's a buy rate, buying the stock, selling the shares. Now, the reason why we brought this up is it was something that had been pushed down. The MACD was staying above the zero and building. And the MACD actually building up near resistance. Those might be candidates that might try to smash their way up through resistance. Now, I want to show a couple other stocks that some investors might be watching. One of those stocks, and tell me if you've been watching it, and I won't tell anyone, okay? I won't tell anyone, it's just me and Jax here. So here it is. One of the stocks that we're going to keep an eye on that did fill in the gap that we're going to be watching this week is on SpaceX. That one today is one that is trying to fill in the gap, okay? Keep an eye on SpaceX. Now, it's not just the price movement. Keep an eye on the volume, the stock volume. Keep an eye on the option volume. Is there starting to be any calls or that are at the money, out of the money strikes? A lot of volume compared to the open interest. Also on the put side, at the money, out of the money. So keep an eye on SpaceX. That's one we've been talking about and also have an example on. Now, the other one is if we continue to see more, let's say, news out overnight, some of the fertilizer comes from abroad, okay? One of the stocks, CF, you're going to see is they actually, there it is, CF Industries, okay, out of Northbrook, Illinois. How come everything's in Illinois? And now what you're going to see is production of ammonia, okay? And you're going to see that a lot of that, some of it has been affected by what's been happening overseas. Now, one of the examples, let's pull this back up to a weekly chart. If we look at this chart, this is one that really we saw on the right-hand side, kind of a run to the upside, pull back, and a little bounce. We're trading right in the middle of that red candle. What are we talking about? You should know what we're talking about. That's what some investors really look for. They buy inside the previous day's ranges, thinking that there could be a bounce set up. They're buying into the weakness of the red candles. On the 1-year daily chart, you're going to see it's right there. Today, we were up to 132.5, fell back down. Keep an eye on that. If we see more volatility, oil goes to the upside. CF of fertilizer is one of the stronger names, okay? Keep an eye on that. Now, the other one that I did post on X, not a recommendation, a couple hours ago, I talked about on X, the movement we saw in Tesla. Now, Tesla had a big green candle right there. Now, do not forget the gap, okay? What do we do with gaps? Well, we watch and see if actually the price can get above where we gap down to. On red candles, where we gap down to, that becomes resistance. We get above that line, we try to fill in the gaps, okay? This effectively becomes a channel. That day was the high up until today. We did see today a big green bullish candle with a cold dot right underneath. We can see that as I move that. And so that's one that's actually trying to fill in the gap there as well. You can see that green dot as I move that line. But remember, if we fill in that gap, it just opens up the path of least resistance to the next level, which would be 410. So remember, do not forget these gaps, okay? They are really effectively support resistance. They are channels, okay? And the biggest thing is it's not just bullish investors buying, it could be bearish investors covering. I'm out of my time here today, but those are going to be some of the stocks we actually keep an eye on. Do not forget about Dell today. Dell has earnings. Paper Money Account has shares. About ready to find out what happens on this after earnings here today. So now remember that coming up next, we got Cameron May. Want to thanks for actually attending today's session on trading with technical indicators, reviewing price, MACD, and also talking about some of these gap fills and channel plays we're actually seeing out there. Cameron May will be coming up next. Thanks to Barbara Armstrong for answering the questions in chat, and thanks to all of you as well. We'll continue to watch some of these trades. I will be in throughout this week, and so we'll follow through on some of these examples we talked about here today throughout the week. Remember that all investing involves risk, and also check out our workshops, in-person events upcoming. And this has been the class on trading with technical indicators. Cameron May will be coming up next, and don't forget to subscribe. Take care. Bye-bye.